Hey guys, it's Dan here. Today we're gonna try to answer the question how to get the fair value of a startup. As always in my videos, I like to start with definitions first. So when you look at how to get the fair value of a startup, let's define the terms fair value and startup first. First of all, fair value, what does it mean? Well, it's the real price. Is a company fairly priced or is it overpriced or underpriced? So that's the first definition. And second of all, what does startup mean? When you look at Google, for example, what startup mean, they're gonna tell you it's a young company founded by entrepreneurs who want to bring innovative product to the market. So this is the real definition of startup. So for the purpose of this video, I will stretch the term startup a little bit more. I'm not going to talk only about the valuation of very young startups. I'm going to talk about different phases and you will understand why I do it. First of all, there are three different phases. So for a company, there is a startup phase, at some point growing phase, and then there is the maturity phase. And I give you some examples of companies as well. So in the startup phase, usually the founder is the owner and puts his own money inside and eventually some seed capital. Usually the startup will become interesting because they need money to grow, so venture capitalists and private equity companies will take over and buy some shares here. We're gonna be in the growing phase, and a good example, for example, is TikTok. You all know TikTok, which is owned by ByteDance, and ByteDance is a company that is owned by some private equity companies right now. And after that, there is the maturity phase, so between growing and the maturity, usually there is the going public, which means you are transitioning from a private company phase into a public company. Here, two very famous examples, Tesla and Uber. So why is it interesting to look at the fair value at all the different stages? Well, first of all, because even in the maturity phase, when you look at Tesla and Uber, for example, which are public companies, they are still newcomers in their businesses. Tesla is ramping up production, they are building cars and they're entering the new market very aggressively. And for Uber, you could say the same about the transportation business. So that's why I would like to take them into consideration. So when we're thinking about valuation of a company and fair value of a company, let's think about when is valuation happening. Well, it's happening each time there is a trade of shares from this company. So first of all, you have a trade of shares when the founder of the company sells some shares to get some cash for the growth, and it's gonna be between here and here. When the founder sells either to venture capitalists or to private equity funds, then there will be numerous funding rounds in the growing phase between early investors and later investors, and at some point there will be another big exchange between these guys here and the institutional investors like BlackRock and all the big guys who will buy shares when the company goes public. So there is a lot of valuation, and obviously if you do it right, the price is going up each time, which is also a bit a part of the problem and overvaluation of companies. So now let's try to answer the question, what drives value of a company at different stages? There are always two things. First of all, there is future financial expectations, and second of all, there is storytelling. So let's focus on both of these, and then we will try to understand and to answer the question how to get the fair value of a startup. Now let's start with the future financial expectations here. So again, I have my three phases here. Let's start with the startup phase. What really matters and what really drives value in the startup phase is the company able to grow revenue over time? When you look at pitches from startups, that's what they all say. They say, well, right now we were not able to generate a lot of revenues, but in the future it's going to be amazing and it's going to go up crazy. So when you look at this kind of pitch and this kind of business plan, ask yourself, what is driving revenue, and is the product and are the people good enough that they're gonna be able to meet these future expectations? This is what will drive the value first in a startup. Then there are two other things to consider: the cost of acquisition and the churn rate. It's good to have revenue and revenue growth, but if it costs you a lot to acquire new customers, you will never be profitable, and it's going to be a problem long term for your business and for the valuation of your business. As well as the churn rate, meaning how many customers are you losing each time. If you're losing a lot of customers, it's going to cost you a lot of money, so it's going to be bad for your valuation as well. So this was the startup phase. Then in the growing phase, it's all about growing, so the focus will be on EBITDA growth, so operating profit growth. How much are you cash burning, and are you gaining market share while you are burning cash or not? What is very interesting here when it comes to valuation is, as I mentioned before, between early investors and later stage investors, there's going to be a lot of funding rounds going on, and usually what happens is there's going to be a real push for higher valuations here. The current shareholders, for example, private equity companies and venture capitalists, they want to push the valuation high because they know exactly at some point they're going to reach the unicorn status here, so the $1 billion if it's a very big promising company. And the thing is, you get free marketing because everybody's talking about the new unicorn. When you look at Bird and Lime, for example, which were very popular like in 2018, 2019, the scooter sharings, they were both unicorns, and everybody talked about them because their valuation was very high. But as we know now, it was probably not that justified because the business model was a bit shaky. But what is very interesting here when it comes to the funding rounds is the more funding rounds you have, the more there is a push for higher valuations, which means that here at this phase, it's pretty likely that the company will be overvalued at this point. And then at some point between growth and maturity, that's where it's gonna get really serious, because here at some point the shareholders, which are mainly venture capitalists and private equity companies, they will take the company public, and here once it's public they will be judged with EBITDA growth, free cash flow, how much debt do they have, and what is the price earnings ratio, for example. So here, and you see it when you look at Uber, for example, they have been absolutely destroyed by the market, not because of the pandemic, but even before, and when you look at until February 2020 or something like that, you will see that the valuation went down very drastically because the investors are not seeing a path to profitability. And this is a very important point, because when you think about the fair value and all the different steps here, profitability at some point will be key. 20 years ago it was key from the start, more or less. Today you see a lot of tech companies who are saying, well, take the example of Uber or Lyft, for example. They are saying, yeah, that's true, we are not profitable. Uber, for example, burned 9 billion of cash in the last 10 years, so absolutely amazing. But they're able to reach crazy valuations because investors see some very high potential in the future. For example, Uber, they are saying, yeah, right now we are still losing money, we're still losing a lot of money, so every ride is subsidized for the moment, but at some point we will get rid of the driver because it's going to be an autonomous car, and then we will have 30% more, because right now this is what they pay to their drivers, so we're going to be profitable. When you look at the market and how they have published Uber, for example, right now nobody's really believing the path to profitability they are saying right now, and that's not linked to the pandemic, but that was also pre-pandemic. Now that we have talked about what drives value, namely future financial expectations, let's look at the calculations. And I made an entire video last week about how private companies are valued. Link here and in the description below if you want to go deeper into that subject. Quick sum up here. So how should the fair value be calculated? There are two methods that are used all the time if you want to value a company. Either it's the discounted cash flow method or it's the EBITDA multiples method. A quick introduction if you don't know what I'm talking about. In the discounted cash flows, the idea is to say, okay, we are here today and we are estimating future cash flows of the company we're talking about. Imagine it's 110 in 1 year, 120 in 2 years, and 130 in 3 years. And as you know, future value today has more value than in the future, so you somehow have to discount it. That's the basic principle of finance. Again, it's in the video from last week if you want to go deeper here. But just to quickly make my point here, imagine you are discounting these three flows with a discount rate of 5%. That's going to give you a net present value, which will be the valuation of the company. Now the question is it fairly valued? Now let's look at it. First of all, let's imagine you are looking at a very promising company. The business plan looks very right, people look right, and all these kind of things. Then you have to ask yourself, because the way to push valuation in this method, there are two ways of pushing the methods. First of all, obviously, the higher the future flows, the higher the valuation will be. Obviously, if you multiply these flows by 2, the valuation will be much higher. I think that's a no-brainer, makes a lot of sense. So make sure that these values here are best estimates and that they are logic, because obviously you can push these to an infinite level if you want to go for a crazy valuation, which usually happens. So here you should make sure that the cash flows make sense and are realistic. That's the first point. The second point is the discount rate that is used to discount the future flows into today's money. What is very important to know here, and here imagine it's 5%, if you push this one down, so let's say instead of being 5% it's going to be 4%, which is used, it's going to push up your valuation. I'm going to show you an example. Very simple. In Excel you can use the NPV, net present value formula, in 10 seconds you get the value. I give you an example. If you use these three cash flows, so 110, 120, 130, with a discount rate of 5%, it's going to give you a net present value of 325. Now let's look at what happens if you twist it a little bit in your favor and if you want to push the valuation up. Now let's imagine, and what I just said, first of all let's push a little bit the free cash flows up. Let's imagine instead of 110, let's add 5 to each. Let's say 115, 125, 135. And on the other side, I am pushing down the discount rate a little bit from 5 to 4%. So what is happening? The valuation at the end, so the net present value, gives you 346. So you're going, by twisting a little bit here and a little bit here, you're going from 325 to 346, which means you have gained 20 of valuation. Let's imagine it's in million, for example, just by twisting a little bit. So what I wanted to say, especially when you're talking about fair value of a startup, is make sure that these estimates are pretty accurate and that they make a lot of logical sense, and also that the discount rate that is used also is in line with the market, let's put it like this. The second method, how companies are valued, is with EBITDA multiples. And here again, you can easily twist the entire thing. Let's imagine a company which has an EBITDA, so an operating profit, of 5 million for the year of today. And imagine in the business plan, the EBITDA in 2 years is estimated to be 20 million, because the company will have a crazy growth, great products coming out, and these kind of things. So you multiply by 4 here. And then imagine the multiple that is usually used, let's say imagine in a similar sector, in the tech sector, is you multiply by 10 to get a valuation. So as you can see here, the valuation really depends on what kind of EBITDA you use. If you use today's EBITDA, which is 5, you would have a valuation of 5 times the multiple, so 5 times 10 gives you 50. But of course, and that's a little trick you see most often, is a lot of companies that want to sell obviously at a higher price will tell you, but hold on, our real potential is not 5, but it's an EBITDA in 2 years of 20. So which means that 20 times 10, that's 200 and not 50. So here you can see how you can push the company's value to a crazy amount. Here again, be mindful. Does it really make sense to have 20 of EBITDA if I have 5 today, you know? Look at the expectations, do they really make sense, or are they just overhyping the entire thing? Now that we have talked about the future financial expectations and how they play when it comes to fair value, let's look at the second part, which is the storytelling. So don't forget what I mentioned at the beginning. Each time there is a transfer of shares, there is valuation of a company. And of course, if you're a public company, you are valued all the time, because that's what market capitalization is. You can check it out every day. The reason why storytelling is so important is because people want to know you, they want to know your products, they want to know your vision, you know? It's not only about I'm investing into a new product, I'm investing into a new vision. I'll give you an example here of a great storytelling. For example, look at Tesla. What would be bad storytelling, for example? It would be to say, okay, we are building electric cars and electric products. That would be a very bad storytelling, because there is no vision inside, you know? Now let's look at their storytelling and why they are so successful. When you look at a good storytelling, that would be, and that's the slogan, Tesla is accelerating the world's transition to sustainable energy. That's kind of a long-term project, a long-term vision. It's not only product-based, but it's a clear long-term path, a long-term vision. I think what is very important also to understand is that the future financial expectation, future performance, as well as storytelling goes hand in hand. I think people can smell BS a mile away, so if you're telling a story that is, first of all, if it's not appealing, it's bad, but also if it's appealing but you are not really delivering, people are noticing very quickly, and the value is going down, obviously. I think to sum up everything we have discussed today, two things. First of all, when you look at the fair value, value is always driven by future financial performance. So make sure when you look at a company, when you're looking at a business plan, for example, does it make sense? Is it realistic? Are the numbers in line with maybe with the market expectation, with what the company is saying? And also, is the story in line? Is it good enough? Are the products good enough? So all these things together really matter. And also look at the structure of the company, because of course if a lot of venture capitalists have been involved, then the value probably shot up very crazily, like for example TikTok, which is very popular, but which has really been pushed by a lot of private equity firms. So I would like to know from you in the comment section below, what are you looking at when you're looking at a company? Is it more the story, or is it more the future financial expectations? So let me know in the comment section below. Otherwise, I wanted to tell you, well, first of all, thanks for watching until the end. Make sure to like my video. It takes me about 7 hours to do, so a like is like 1 second. And make sure to subscribe to my channel if you like more market and corporate finance videos like this one. I post once a week every Sunday. See you soon, guys. Enjoy your week. Bye bye.